In May of 1969, Buffett sat down and wrote a letter to all his investment partners. He had a small fund back then, it was kind of early-ish days for him. And in that letter, he basically said, I'm closing the fund. I can't find anything cheap to buy. The market is full of speculation, he said. Aggressive money is everywhere. I'd rather give you your cash back than chase prices I don't believe in. Look, the fund had returned almost 30 times the partner's money over 13 years. So he was at the absolute peak of his power, and he just walked away because he couldn't find anything valuable to invest in. What happened next? Stocks went sideways for the entirety of the 1970s. Investors who bought in the 70s chasing the hype got absolutely destroyed. Side note, by the way, those who bought gold and silver, they did very well, which is why I also hold a lot of gold and silver right now. Anyway, this also happened in 2007. Buffett spent the year selling stocks and stacking up on treasury bills. He didn't go on TV and scream sell. He just kind of stopped buying. By the time the music stopped in 2008, he was sat on the biggest cash pile in Berkshire Hathaway's history until now. I mean, he's sat on more cash right now, which should tell you something, but we'll talk about that. Anyway, the 2008 crash happens and he puts $5 billion into a distressed and collapsing Goldman Sachs. Well, collapsing is a stretch, but into a distressed Goldman Sachs, or Goldman Sachs. I think he made like 2 or 3 billion from that. I think it was free. He then throws 3 billion into General Electric. He bought the blood essentially, and he made an absolute fortune doing it. So his pattern is not predicting crashes, it's preparing for them and waiting patiently. And this isn't even rocket science, guys. See, Buffett knows something all of us know. All of us know this internally. When something is grossly overvalued, it eventually corrects. You don't need to be a rocket scientist. You don't need to be a genius to know this. He just has the balls to call it out and the patience to wait for every other idiot in the room to realize. That's why he's one of the best investors, or some would say the best investor of all time. Which brings us to last week. Buffett is sitting on stage at the Berkshire Hathaway annual meeting, well, in the audience, but this time something is different. For the first time in 60 years, he's not the one running it. He stepped down as CEO on January 1st. 𝗥𝗲𝗹𝗁𝗁 is in the chair now, and Warren, he's just sat in the audience. I mean, this was his last big public statement as the boss, or, at the conference. It was his goodbye address to the markets. And what does he say, right? 3 times since I've taken over Berkshire, it's gone down more than 50%. This is nothing. This is referring to the 10% retrace we had in March. He was talking about that correction. Basically, he's saying that the 10% dip was nothing, and a big dip is still coming. The kind where SPX loses half of its value, the kind that he's lived through 3 or 4 times in his 60 years. And then he says this: if there is a big decline, we will deploy capital. The operative word is that in that sentence is big. A 10% pullback isn't big. A 15% correction isn't big. Buffett's not interested in any of that. He's waiting for another 2008 or another 2009, both of which he made billions from. That is the only environment in which he wants to buy. So what does he have ready to deploy? Well, he has roughly $373 billion. That's a lot of money. That's the size of Berkshire Hathaway's current cash pile, cash and treasury bill pile. It's the largest position in corporate history. And I'll remind you, last time Buffett was sitting on a record cash pile was 2008. And that is a big number, by the way, $373 billion. That's massive. It's bigger than the entire market. I looked this up. It's bigger than the entire market cap of Bank of America. It's bigger than the GDP of Denmark. But funnily, it's only half of an Elon Musk worth of money. So if you cut Elon Musk in half, he's worth roughly $373 billion. Anyway, it's just sat there in treasury bills earning 4% for him. Some of it is in cash. Buffett has been building this cash pile for years now. He sold Apple, he sold Bank of America. He still holds some of those, of course. He sold Kraft. He's never done that before in his entire career. Not in 1999, not in 2007, not ever. He's selling Kraft now, though. And it's not just that he's selling. The Buffett Indicator, his own kind of pet metric, let's call it, the ratio of total stock market cap to US GDP is currently sitting at 230%. I need to put this one into context because it's an insane number. That indicator was at 150% the day before the dot-com bubble burst. It was at 110% before the 2008 crisis. Today, it's at 230%. Basically, this indicator is a measure of how overvalued the stock market, and it's overvalued. It's a measure of how overvalued the stock market is. When the entire stock market is higher than the US GDP, it's overvalued, according to Buffett. Like I said, other crashes, it was at 110%, 150%. Now we're at 230%. That is an insane amount of overvaluement. Whatever. And Buffett himself, decades ago, called this exact indicator probably the best single measure of where valuations stand at any given moment, right? So you have the inventor of the indicator looking at the indicator and saying, yeah, I'm out, bro. By the way, guys, if you want to stay up to date with what's happening in the markets, subscribe to my free newsletter. I publish a report on everything you need to know about the markets every single morning. Basically, I read 20 to 30 articles, I summarize them so you don't have to. There's a link below. Like I said, it's free.